Hey everyone, it's Evan here from thetraderisk.com, and in today's video, we're going to be discussing how to develop simple swing trading strategies. Now, if you're finding this video just natively on YouTube, welcome. We wrote this as an article first, then produced the slide deck and recorded the video. So if you're interested in reading this in article format, there should be a link appearing right now in the top right-hand corner of your screen. You can click that link, you'll get directed to thetraderisk.com. You can read this article instead of listening to me, for probably a half hour or so, or however long this video is going to take. There's quite a bit to cover. In the article, we break things up into sections, so you should be able to kind of scroll through and jump to what you want to hear. And we'll also, in the description of this YouTube video, we're going to put the timestamps in the sections that we're going to talk about. So if you do kind of want to skip some of the intro definitions and terminology, you can look at the description, you can jump to the section that you want to hear, and hopefully get the information that'll help you. Also, if you like this video, if you're interested in more sort of long-form educational lessons, all for free, go to thetraderisk.com. There should be an education or a learning center link there, or on YouTube there should be a playlist for trading education. There's plenty of more previously recorded long-form educational lessons. There's more articles than there are videos, but if you like it, check those two spots out. And again, you can head to the description of this video for more links and resources on how to get there. So with that, let's get into today's video: how to develop simple swing trading strategies. Now, we're going to start by asking the question, what is the goal of swing trading? Okay, so before we get into all the nitty-gritty, let's talk about some of the high-level questions here. What is the goal of swing trading? Now, in this green box, we have a definition of swing trading as a trading approach. So let's go through that first. Swing trading is an active approach to trading the markets where the planned holding time of the trade extends beyond a day, and the goal is to capture a single leg or swing in a stock's trend. Okay, so this is an active trading strategy. It's one that does not require you to sit in front of screens all day as if you were day trading, and you're not quite a trend follower. You're not quite holding trades through pullbacks and kind of sitting through the entire duration of a trend. You're trying to capture just a single leg within a trend, and you're not quite on the position trader or investor's time frame where you're holding things for 3, 6, 12 months or more. You are tactically sort of going after those single legs within a trend. So why do this? What's the goal of going through the effort of swing trading? Well, the first is to mitigate risk. You want to be able to manage risk in some sort of methodical process. Swing trading can absolutely solve this problem of mitigating risk. Produce excess returns or alpha. You're trying to outperform the market or whatever your favorite benchmark is. Swing trading, again, is an active trading approach that can do this. And then finally, you're really, to put it together, you're profiting from short-term trends in the marketplace and overnight price movement. So we know what swing trading is. We know why we would want to do it. And now let's sort of get into the discussion of developing a swing trading strategy. Why develop a trading strategy in the first place? So throughout this video, I'm going to always we're talking sort of specifically with swing trading strategies, but most of the 90% of these concepts of developing trading strategies are sort of universal, so you could apply it to any type of time frame. So if you are watching this video and you are a day trader, or you're thinking about developing a strategy for some alternative time frame, most of what we're going to talk about today is just very, very much applicable. So why develop a trading strategy in the first place? Sort of our second overarching question. Well, as fun as it would be to wake up every morning and just off the cuff decide what stocks you're going to trade, when you're going to get into the trades, when you're going to exit the trades, how much size you're going to put on, as fun as it would be to just completely throw darts or roll dice and make up those decisions and get those results, it's not practical. It's not realistic. There are probably some people that do it. There's very few of those select people that can actually probably make money over the long term. I would argue most people in those shoes of pure, just discretionary, no trading strategy would be, it would be more of a hobby for them than it would be an actual sort of methodical business practice or a means of generating real income. At risk of sort of offending some of the audience here, that is humbly my opinion there. So in order to achieve and maintain consistency, we must develop a strategy or set of rules that we're going to follow day in and day out. And the reason is, by executing within our rules, we can then document our results, verify performance, and identify what is and what is not working. If you're 100% random and fully discretionary with every aspect of trading, it is going to be extremely difficult for you to actually figure out what is working. Are you getting lucky, or do you actually have some super intuitive skill towards the markets? By executing the same entries, the same exits, managing the trades very similar, right? By doing that, you can then create a well-documented sort of paper trail and decision-making process that you can audit 30, 60, 90, a year later, 30, 60, 90 days or a year later, and start to figure out, oh, okay, I'm actually getting in too early. I need to modify my entry a bit. I need to adjust that. Or I'm holding on to trades too long. I need to figure out how we can solve that, right? So by creating a strategy, having a set of rules, we can then start to figure out what is and what is not working. So we know why we want to swing trade. We know what swing trading is. We know why we need a strategy. Let's get into the good stuff. Let's start from the beginning, building your trading strategy foundation. Now, there's 5 or 6 steps in this process. They're by no means the gold standard for creating trading strategies. They're just my interpretation of some good guidelines and sort of a path that we should be following. So building your strategy foundation, let's get into it. What we're looking for here is a repeatable pattern to measure its profitability. That's what we're starting off with. It's almost a hypothesis. Think of yourself as kind of executing on the scientific method here. We're trying to hypothesize and find a repeatable pattern that we've either observed through markets or something we're simply going to test out. The simpler and more straightforward your rules are, the more robust and evergreen your strategy will be. Now, this is sort of something we're going to continue to come back on, this concept of robustness and not overfitting a strategy. And I don't want to get ahead of myself, but the way to really think about this is there are sort of core truths or behaviors of the market that are almost going to be persistent and evergreen and will always exist. For example, I'm going to use this example probably a few times throughout this presentation because I think it's a well-documented strategy with a lot of research behind it, and I think a lot of people understand it, is trend following. So systematic trend following. That is something that I would consider very timeless. It's evergreen. It's very simple. It's straightforward. And we're always going to have trends in markets. They may look different. They may happen faster. They may have, super quick pullbacks and corrections that last, only a day versus a month. But we'll always have trends in markets. They are the basis of price movement. That, to me, is a very evergreen strategy. Now, importantly, it does not mean, and generally this is true, it does not always mean it is the most profitable way to trade. Now, I want to get away from trend following there. I don't want to use trend following as sort of under this umbrella. The point is that when you're developing sort of sophisticated, nuanced strategies, arbitrage, when you're really trying to you're trying to exploit something that is fairly complicated, may not be super intuitive, and you're creating something like that, I think they can be very powerful. I think that's where most of the alpha is. That's where most of the strategies are that are going to generate really high returns. But you need to be careful that that little inefficiency does not go away on you or start to evolve, or the market sort of figures it out. So you run the risk of saying, again, this concept of sort of a straightforward, robust sort of foundational approach to markets versus something that's very nuanced, complicated, or specific to a certain type of inefficiency that you're noticing. Hopefully that makes sense. I'm just trying to draw the distinction there between what we're going to have to talk about later on when we get into maintenance and sort of the evolution of a strategy. Everything can work here. I'm just trying to sort of give you a sort of line in the sand of thinking about this in a sort of very structured fashion. So let's leave this topic here for now. Again, if you guys ever have, if you have questions about anything, leave a comment below. We're gonna dial back into sort of this concept a little bit later in this video. So building the strategy foundation, we're looking for, again, a repeatable pattern to measure its profitability. In this slide deck, in this article, in this example, we're going to use price action, the study of price action, as our sort of example framework, okay? So here's the example that we're going to start working with to build our simple trading strategy. Over any period across any market, we can come up with a set of rules to classify price movement as either trending or range bound. This is a concept of sort of a foundational principle of markets. And again, if you're a student of price action, this is very intuitive and makes a lot of sense to you. On the left here, we have a range bound market. Notice price is depicted as a line chart here, is just going completely sideways, up, down, one step forward, one step back, and there's no trend here. It just goes from left to right in the same exact spot. Whereas the chart here on the right, again depicted as a line chart, starts in the bottom left of your screen and ends in the upper right of your screen. That's a trend at its very core. Notice it has various degrees of pullbacks. It's got little ebbs and flows in between. But overall, that is an uptrend. So this is going to be our foundational sort of framework on how we're going to develop a simple swing trading strategy. We're going to use price action here, depending on which state we're in, to come up with some rules to actually make some money and generate some profits on these types of patterns. There are a ton of ways. We go more in depth on some of them in the article format on how we could define what a trend is, right? This is where some subjectivity and creativity come into play, but you can use simple moving averages, you can use higher lows and higher highs, you can use sort of absolute momentum. There's plenty of ways to sort of understand if a market is trending or not, and it's going to depend on your time frame and up to you basically, but we have some more examples there on the article format. So let's take a look here at a uptrend of a stock price line. So what I've done is I've highlighted and circled all of the swing low to swing highs in this uptrend. So here's price line. You can see 4 different swings that we are looking to try and capture here as swing traders, right? So the question is, can we capture, or how can we capture this movement in a positive expected value risk adjusted way? Okay, it's easy to look at this and say, well, just buy and hold it and become a trend follower, right? But we're thinking about this as a swing trader. We want to be a little more tactical. We don't want to sit through all those pullbacks. We want to keep looking for opportunity and sort of rotate our capital into stocks that are constantly moving. So how can we capture, looking at this example, how can we define an entry and exit, trade management rules to effectively capture this and come up with a repeatable trading strategy? Well, we're going to do that. And I'm going to pretty much hand over the rules to you. So this is step 2, is creating trading strategy rules based on some foundational principle about markets and some past examples or observances, that you have in the markets. There's lots of ways to come up with different trading strategy rules, and we're going to show you how with this example. So we're going to leverage what we know about trends, and we're going to put together some rules for the price line example. Now, one thing that we didn't get into about trends, which we did cover in the article, is that trends have this fascinating principle of when a market is trending, it actually wants to persist in that state of trending. It's kind of like, an object in motion stays in motion. It's very similar to that in markets, and it works both ways. So if a stock is range bound, or if a market is range bound, it tends to want to stay range bound. It tends to fail at the extremes and revert to the mean. When a stock is trending, well, it actually wants to persist in that trending state, and as soon as it kind of looks at its worst and it's pulled back for several days, that's where that magical bid sort of shows up, and it continues to it finds support, pivots higher, and then continues in its uptrend. So that's this wonderful sort of principle, foundational principle of markets that we're leveraging here. And we're going to combine that with some hopefully more refined and actionable rules based on this price line example. So our first rule is going to be wait for a close under the 20-period EMA, and that was the yellow line on the chart. We'll go back and look at the chart in just a minute as soon as we go through these rules. So we're going to wait for a close under the 20-period EMA, and we're going to buy the first bar, the first close, over the 20-period EMA and above the prior day's highs. So we're going to wait for a close under the 20 period. We're going to buy the first close back over the 20 and the prior day's highs. We're going to put a stop loss, which means we'll exit the trade if it hits this point. We'll place a stop loss at 1 ATR below the entry price. So that's an average true range. So we're going to look at the volatility of the stock. We're going to just put a 1 ATR stop loss in below our entry price, or below the prior swing lows. You could do whichever is further. We're going to take half the trade off at a 1.5 ATR multiple, so 1.5 times our risk. We're going to take half the trade off. And then we're going to exit the remaining below when we get a close below the prior 3-day lows. That is the entire trading strategy, and we could label this as a price action pullback strategy for stocks in an upward trend. Very key here, the stock needs to be in an upward trend before these rules are executed. So we need a stock in an uptrend before we start to execute on this trading strategy. So if we go back to our price line example, you can see in every case the yellow line there is the 20-period EMA. Anytime we get a close under that 20-period EMA, we're going to buy the first bar back above the 20 EMA and above the prior day highs. You can see that would capture every single instance here. We would take profits at 1.5 times the ATR, the stop loss, and we would exit on a close below the prior 3-day lows. It's a trailing stop on the remaining position. We would capture all of these profits here, and it would do fantastic. Now, I know what you're thinking. Well, you're just looking at one example. You're looking at one little pigeonhole example, and that is absolutely correct. We are only looking at one example here. Ideally, and again, we're in the hypothesis phase, right? So there's not necessarily something wrong with this. We just need to actually test this out on a few other examples and other data, and we're going to get there. So simple and robust. Let's go back to those two terms. Using our rule set, we have a defined entry, profit taking, and exit condition. And we've also included some risk management using that initial stop loss. We're only targeting stocks in uptrends and trading exclusively in that direction. So we're not doing any shorting. We're only buying trades in an uptrend. Okay, and I think that's very important. That goes back to our foundational principles here of trends. We only want to target stocks in uptrends, trade exclusively in that direction. We're using a predefined stop loss to limit losses. We're taking partial profits at 1.5 multiple of risk to reduce whipsaws and smooth equity curve. And we're letting the remaining half of the trade run as far as the trend is willing to take it in order to maximize profits. Everything here should be fairly simple and robust. There's nothing extremely nuanced We're taking advantage of trends. We're taking advantage specifically of uptrends. We're only buying in those uptrends. We're limiting our losses, and we're letting our winners run. So we are almost like trend followers. We do have profit targets that we're putting in at the initial stage of entry. So that's unlike a trend follower. Generally, it doesn't take profit targets. But we're also taking a pullback entry instead of a breakout entry. But these types of things, pullbacks, trends, are all sort of, again, evergreen sort of concepts or principles of markets. Okay, so hopefully that makes sense. Now, are we done here? Did we just discover the Holy Grail? We clearly just knocked it out of the park with our price line example. Unfortunately, like we said before, we need to test this on more than just price line trade example, right? We're only looking at one example where we generated these rules, so we're going to need to backtest this. Now, backtesting it is, if you've never heard of this concept, is the process of testing a trading strategy on relevant historical data to ensure its viability before the trader risks any actual capital. That is a definition directly from Investopedia. A trader can simulate the trading of a strategy over an appropriate period of time and analyze the results for the levels of probability and risk. So that's kind of a mouthful here. Here's my simplified version, or here's some quick tips, and then I'm going to give you my sort of simple version. At a high level, the goal is to validate our trading strategy across as much in-sample and out-of-sample data as we can get our hands on. Okay, so essentially what we want to do is we want to take those 5 rules that we came up with, and we want to go over as many charts as we can get our hands on that we can apply that rule set to, and we want to just document, did we make money? Did that make money? Did that make money? And we want to just run that occurrence and those rule set over hundreds, thousands of possible charts and data sets, and we want to see, okay, we know price line, it turned great, but as a whole, after we look at all 1,000 of our back-tested examples, did we make money? That is the concept. That is what we're trying to figure out when backtesting. So some rules when doing this, some quick tip rules. There's a ton of nuance when we go into backtesting, and this is not an article devoted to backtesting, you should absolutely read up on this subject. It sounds very easy, but there's a lot of little traps that a trader can fall into when backtesting. I'm going to give you just a few high-level, the broad strokes. Don't forget to account for slippage and commission costs, right? So it's easy to put the rule set and kind of look at paper math, but don't forget, in real market terms, there's slippage every time you enter and exit or take profits in a market, and there's commission costs. So make sure you factor that into a trade, into your trading results or the performance at the end. Test multiple market regimes, right? Only testing from 2009 to 2017 puts you in a major bull market. You don't have any big bear markets to worry about. You don't have 2008, you don't have 2001, 2000. You got nothing of that. So make sure that you test multiple market regimes. And depending on the time frame, that's going to be appropriate. If you're a day trader, of course, you don't need to test 17 years of data. You could probably get by with, a year or two if you're trading shorter time frames that have a lot more occurrences. Another little tip here is if a 20-day moving average works great, and this is just a hypothetical, if a 20-day moving average works great, but an 18 or a 19 or a 21, if all those moving average parameters right around the 20-day, if they all perform drastically different, be very cautious. In other words, you want a 20-day to work great, you want a 21-day to work great, you want a 22-day to work pretty good. You want all of the sort of surrounding parameters to work reasonably well. They may not have to be the best, but they should work well. You don't want drastic drop-offs, because that's going to tell you that something in the data, something that you've, quote, data mined out of there, or you've just luckily kind of fallen upon, is working great with that 20-period moving average, and all of those others next to it are not working great. That says that that's not a very robust or reliable sort of rule that you have, or inefficiency that you're really sort of capturing there. So keep that in mind. There's a ton of more just like this that you want to be careful of, but I suggest that you definitely read up more onto backtesting. Now, backtesting, okay, we're going to sort of really narrow down here on this single slide. You're looking to validate the robustness of your rules, making adjustments where necessary, but very importantly, you do not want to excessively adjust rules and parameters, as you will run the risk of curve fitting your strategy to your data set. So that's a mouthful here, but backtesting gets an interesting response depending on which camp you're in. Some people really dislike and throw away, dismiss the results of backtesting, and other people probably overemphasize the importance of it. And I think the sweet spot is somewhere in the middle. The danger that you can run into with backtesting is you can take those 5 rules that we just created, you can apply them, you can input them into a trading, into a backtesting piece of software, and you can say, that didn't work so well. Let me try an 18-day parameter. And let me tweak this entry just a little bit. And all of a sudden you start tweaking until you get something that looks fantastic. The problem is you're tweaking it to get it perfect on the data set that you're using. And that's all historical data. So what happens is you have something that works wonderful based on the last 5-6 years of data. But when you put it into real time, markets are not going to behave exactly like they did in the past. So this is why we harp on sort of having generalized, sort of robust and evergreen rules, not getting too specific and niche in your rule set, because that can cause kind of that curve fit when you get really complicated, a ton of rules, and you start really doing optimization on all of the different parameter sets. That's when you can really run into issues with backtesting in general. So again, I encourage you guys to definitely learn more about the process of backtesting. I think it's necessary. I think you want to understand, and you want to basically get that risk profile down. You want to figure out, based on that backtest, how am I performing? What are my drawdowns look like? How much, what is my winning percentage? What is my losing percentage? How many losers can I expect in a row? Those are the guidelines. Those are the things that you really want to pull away, so you understand when you go live, oh, okay, I know my backtest said, at one point I had 8 losers in a row. So the fact that I have 5 in a row right now and I'm trading it live, that seems reasonable. Like that can happen. So those are the types of things that you want to start to, you really want to pull and get out of the backtest. So backtesting equivalents for discretionary traders. That's where I fit in. I have some discretion. I have a fairly systematic process, but there are some things that are discretionary in my process, and you can't just input those rules into a piece of software. You can't write all those rules, code those rules and run that backtest, because there are some discretionary elements. So how are we going to get around this? Well, there's no perfect way, but discretionary trading systems that rely on varying inputs and dynamic weightings of those inputs will not be able to backtest in a traditional fashion. So the closest equivalence is to paper trade or build a track record of live trading results. It's one of the two. Now, the problem with paper trading is you're not going to have the emotional sort of influence when you're paper trading, right? There's no actual loss of money or fear of losing money or fear of sort of missing out. You're just paper trading. So what I did is go live with my trading strategy fairly quickly. I backtested what I could based on some rigid rule set. And then I decided to take it live. But I didn't take it live with a huge amount of risk. I actually took it live risking anywhere from, most trades were actually just 25 bips is what I was risking per trade. That's 0.25%. So I did that for an entire year, risking 0.25 to 0.30 for an entire year on my swing trading strategy. And after that year, I was comfortable with sort of the risk profile. I knew what to expect, where trades were losing money. I did a little bit of refinement in there. And the next year, I upped my risk to 0.5 to 0.5% per trade. And I did that for an entire second year. And once that second year was done, I said, okay, I understand this system. I understand where it works, what its strengths are, what market environments it's not so good in. And then that third year and current levels, I risk up to 1% per trade. And that's the maximum I want to risk. I don't feel comfortable risking any more than that. But it took me basically, over 2 years to get to that max risk point, to get to that point where I'm comfortable, where I have my trading results, I have enough data on my set that I can actually start risking kind of the full amount and really starting to execute on the trade. So I don't know if most people would take 2 years to do that. I think it's a great approach. I think it's the best approach if you're a discretionary trader and you can't backtest in a traditional fashion, is to start slow. It depends on how many occurrences you get, right? If you're taking 5 trades a day, then you probably don't need to wait 2 years. If you're trading a little less frequently, you're going to want more data. You're going to want to get across a few different market regimes to really understand sort of how your system works, how your strategy works. So hopefully backtesting or trading live and small is going to be the way to get that profile down for your trading strategy if you're a discretionary trader. So step number 4, by the time you're done with your backtest, you should have a pretty good idea if what you have is worth pursuing, right? Remember, a profitable backtest does not guarantee your system will perform that way into the future. We want to really take out of our backtest, what is the risk profile? How many losses in a row can I expect? What's my win percentage? What do drawdowns look like? How long am I in drawdown? Those are the types of things you want to take out of it. You don't want to curve fit the hell out of that system and think that you've discovered the Holy Grail, can just sit back and let the profits roll in. Profitable backtests do not guarantee your system will perform that way in the future. We're going to talk about that in just a little bit. If you don't find something producing favorable returns, if you go through the backtesting process and you're just barely kind of breaking even, you're winning maybe just slightly, maybe not so after you factor in commissions and the time it's going to take to execute on that strategy, you really want to resist that temptation to make continual tweaks to fit your data set for all of the reasons that we just finished up discussing. It's generally recommended to start over with a fresh foundational idea, new trading strategy, new rules. Let's just start over from the beginning and see if we can construct it based on some prior observances or trade examples like we looked at with Priceline, and trying to sort of, reason out some new rationale there. So, maintenance and improvement strategy, step number 5. So, unfortunately, like we said, you cannot expect to sit back and enjoy profits indefinitely. You'll need to constantly monitor your system and verify everything is operating as your backtest and live trading experience suggest. Sooner or later, you're bound to experience a larger drawdown than you are used to, right? It will happen. As much as you don't think it will, you're going to hit either some set of events will hit the market, you're going to see some really big change of character that you're not used to, or you're going to experience a larger or longer drawdown than you are used to, and you're going to start to doubt your trading strategy. It happens to everybody. Even if you've been trading your strategy for a long time, it's amazing to see, and I feel it personally, when you start to go through a period of a month or 2 months or longer of drawdown or of results that are just sort of treading water, you're going to doubt your system. It's totally, it's human nature. It's what we creatures do. And here's what you need to ask yourself in those situations. Is my system performing as expected given the current market conditions, the inputs to your system? So in other words, if your system, and this is something again that you want to figure out from your backtest, you want to understand sort of where your strategy lacks. Where does it actually start to perform lousy? And let's say, for example, your system performs lousy during low volatility environments. Let's say you need volatility, you need movement, right? And during low volatility environments, your system starts to draw down because there's just not enough movement. It takes entries, they get stopped out. It takes entries, it gets stopped out. So low volatility environments are bad for your system. Well, that's a pretty translatable market environment characteristic right now, because in 2017 we basically have a stretch of the lowest volatility we've ever seen. And if your if your strategy does lousy in low volatility environments, you should expect lousy returns. There's nothing wrong with your system. It's actually performing as expected. It's performing lousy because it's in a lousy market environment for it. So that makes total sense. Now, on the other hand, if you have a system that works wonderfully in trending markets and the market is strongly trending and you're in drawdown and you're taking losses unusually big or for long periods of time, that's something you need to pay attention to, because if you know historically and you have lots of occurrences of your system performing well during uptrends and all of a sudden you're in an uptrend and your strategy is losing you money consistently, that's something you need to pay attention to and sort of refine, look into, and start to ask yourself, did something change here? Are my rules not in fact as robust as I thought? Has the market evolved in such a way that my strategy is no longer sort of in fashion or worth pursuing? Those are the types of situations where you need to really question that. So hopefully that distinction is made pretty clear, and it segues very nicely into trading is not always smooth, right? It would be wonderful if we could get paid steady weekly dividends for all the hard work that we do as traders, right? Dealing with our systems, executing on the systems, handling the emotions, creating the strategy, everything in between, right? It would be great if we could get paid consistently, but that's just not how trading works, right? The truth is most trading strategies aren't correlated with the S&P 500. They offer lumpy returns, and they leave us disappointed most of the time. It sounds pretty lousy when you look at it like this, but honestly, particularly with trend following, again, this example that I think is got well-documented return profiles of exactly this, right? They're not correlated much with the S&P 500. They go long periods of stale results, but then they have huge outsized years, and most of the time they're in drawdown, and they're going to be disappointing most of the time. But if you have a long-term sort of absolute return approach, then you can get through this. You can understand the larger vision that trend following strategies are actually wonderful, but you need to be able to deal and stomach the short-term disappointment. And let me tell you, try executing on a strategy and being down, day number 137 of a drawdown, while the S&P 500 rips to new highs, while everyone on social media or on Twitter is talking about how much money they're making on their trading strategy, right? The only thing you're going to think is, what a piece of shit system I have. It's not working. This is frustrating. I need to go somewhere else. I need to get a new trading strategy. And you need to understand that that's not realistic. That's probably not what you should be doing. You should be asking yourself that question: is my system performing as expected given the current market inputs? And if that is true, you probably want to you probably want to stick out your trading system, because chances are a period of outperformance is right around the corner. Just like when investors are picking managers to invest in, they tend to follow performance and chase performance. And generally, when a system is doing horrible, when it's underperformed for enough time, that's right when the best time to invest in a manager or a trading system is, because it's about to hit its upswing. And just like in markets where the average trader is horrible at timing markets, it's the same thing with trading strategies. It translates 100%. It tends to be at its worst when a trading system starts to work its best. So resist that temptation to get very upset. It's easy to, though. Again, with this, just think about it. Being on a long-term drawdown while the S&P 500 is at highs, while everybody else is doing, or quote, doing well on social media, unverified results, that can be psychologically very difficult to deal with. So start mentally preparing yourself if you're going to start trading a system that has 50% win percentage, even 60% win percentage. You're still going to have plenty of losers in a row and go through periods of drawdown. So just keep that in mind. My results for 2016, you go to thetraderisk.com, you can see the performance for 2016. 2 months of 2016 made up 80% of my profits. So basically 10 months of 2016, I was basically, kind of chopping around, making a little, losing a little, not doing a whole lot. And 2 months of my year made almost my entire year, 80% of it. So again, I'm speaking from experience here, and I'm not a trend follower per se. It can be lumpy, and you're not going to get a linear return stream. You're not going to get that linear paycheck like some people really desire. So keep that in mind. when you're thinking about this. Now, one thing we haven't talked about much is risk management and position sizing, and it is king when thinking about trading systems. The most profitable trading strategies in the world can turn disastrous. They will turn disastrous in the hands of an irresponsible or overly aggressive trader. In other words, if you're risking, if you're going all in on your trade signals every single time, you can have the best strategy in the world with the largest edge, but you will go bankrupt because you're betting too much per trade. So apply some common sense principles. We're going to talk about a few of them now. Also understand, though, there is a difference in risk tolerance between, say, a 20-year-old college grad versus a 60-year-old on the verge of retirement, right? Those are very different risk profiles and outlooks and expectations for what those two types of people, those two traders, are looking at from their system. The 20-year-old college grad can probably risk 2% per trade, and that would be perfectly reasonable because they may not have a lot of capital, they have a ton of time in front of them, and they may be trying to get an early head start trading pretty aggressively. On the other hand, that 60-year-old probably shouldn't even have all of his money in one strategy, let alone risk. Even 1% per trade would probably be too much, assuming they have $1 million trading account or something even more than that at that age. So keep that in mind, that the personal sort of thresholds are going to very much vary depending on the circumstances and the amount of capital that one has. But here's some risk management. Here's some quick rules to sort of think about when you're thinking about risk management, when you are putting together a strategy. Always have a predetermined price selected where you will exit the trade when or if it doesn't move in your favor, right? You always need a stop loss. You always need a point of saying uncle. It doesn't have, it could be a time stop loss as well. There's lots of ways to get around this, but always have a way to exit that trade if it's not working in your favor. Never risk more than 1% per trade. Again, that's something I live by. Again, if you're that 20-year-old trader that has only $10,000, $15,000, a low amount of money, or a something that you really are trying to just accelerate on and grow quickly, that could go to 2%. That could go to 3% maybe, but that's going to be, you need something. You need a line in the sand at some point. Never enter more than 20% of your capital in an individual stock. So don't go all in on any one thing. Make sure you actually parse out your capital and you don't run the risk of sort of blowing up on one small biotech stock. And again, that 20% threshold should maybe be 5%, 10%. Maybe it could be 40% for someone else. That'll depend on you. Always factor in a stock's historical volatility. Here's something I don't see many people do, and I'm a big fan of it, is looking at the average true range, looking at some sort of standard deviation of volatility and price movement to understand sort of how much you can expect this instrument to move that you're about to trade. That way you don't get blindsided. And I talk about this in a how to position size when swing trading. There's a post on the website that I definitely recommend for more risk management principles and how to see all of these combined at once. But I think it's very important to really look at a stock's historical volatility, because I think that can that can give you some insights. If a stock's currently trading at a very quiet period, you may get a false sense of security, whereas if you look back over the past year or so, you actually see, oh wow, this stock moves on average $5 a day. It just happens to be moving 50 cents a day at the time of looking at this. So keep that in mind. There's some quick risk management tools, and I'll have more sort of articles below this in the YouTube description. So that's the last slide I have. We're really going to wrap it all up here now. Basically say lots of work goes into creating profitable trading strategies. That should be clear. Requires an investment in time, experience with markets, and creativity to put together a unique strategy. There's a lot of different elements here, and it's going to take time and experience. You're going to start over. Not all your strategies that you hypothesized from the beginning are going to be profitable or are going to be things that you really want to trade. So you need to keep that in mind. We couldn't possibly cover everything. There's a ton. I mean, especially when I started writing this article, I mean, there were just more and more, and there's plenty more that I even want to talk about that we didn't get to. But I think we talked about at least a good path to embark down when thinking about trading strategies. And there's, again, a lot of more nuance. There's more risk management. There's plenty more in back testing and other ways to sort of come up with different trade ideas. But hopefully, at the cost of making this, a 3-hour presentation, maybe we'll do a part 2. If you guys have questions, if you want to know more about something specifically, leave a comment below, either on the article or on this YouTube video, and I will happily respond to it and potentially do a part 2 if we have enough interest in some certain topics on trading strategies. And again, as I mentioned, there's lots more links in the YouTube description. So hopefully this has been helpful for you guys. Head to thetraders.com. There's, again, a lot more there. You can follow me on StockTwits or Twitter. And if you subscribe to this YouTube channel, you get up to date with all of the general market analysis and sort of actionable trade ideas and different things that we publish on a regular basis. So thanks so much for watching. If you got through this from start to finish, you're a champ. Good job. And I hope to talk to you again in another video. Good luck trading, and talk to you again soon.